Welcome to this explainer. Today, we're going to untangle the completely chaotic web of recent Federal Reserve policy, weakening economic data, and geopolitical shocks to figure out what is truly happening in the gold and silver markets. It's been an incredibly wild ride lately, for sure. And to understand where things are heading, we really need to cut through all the noise and look at the actual data driving these massive market swings.
So let's dive right in with an absolutely crucial question that, honestly, most investors haven't even asked themselves yet. Are you betting on a Fed that holds the line no matter the cost, or one that bends the moment real pressure arrives? Because whether you realize it or not, your precious metals position quietly assumes that one of these two realities is going to play out.
Section 1. The Chairman's Bold Promise.
To really get a grip on the Fed's true stance, we got to rewind just a bit to July 1st, over in Sintra, Portugal. Newly installed Fed Chairman Kevin Warsh took the stage, completely defied Wall Street's expectations of easy money, and laid down this Volcker-style commitment right out of the gate. He was pushing back hard against both market hopes for a rescue and against the political apparatus. But here's the really fascinating detail. In that exact same breath, he cited the recent US-Iran ceasefire and sliding gas prices as the core reasons why inflation expectations were naturally cooling. His entire hawkish stance rested on a very specific and honestly very fragile geopolitical backdrop. But then, literally just 72 hours later, the ground completely shook. 57,000. That is the frankly dismal number of jobs added, as revealed in the June jobs report. This completely missed the economic forecast, which was banking on over 113,000 jobs. And right there, that initiated an immediate, direct collision between the chairman's firm policy promises and shifting economic reality.
Section 2. The 10-Day Market Whipsaw.
Now, what's really fascinating here is how incredibly fast the chairman's foundational assumptions just cracked. Let's unpack the real weakness behind that jobs report. Yeah, sure, unemployment ticked down to 4.2%, but that was basically an illusion of arithmetic driven by a falling 61.5% participation rate. Basically, fewer Americans were actually looking for work. Plus, April and May were revised down by a massive 74,000 jobs, and leisure and hospitality alone shed 61,000 positions. Yet, just to complicate everything, wages kept climbing, up 3.5% over the year. This super weak data caused rate hike odds to just plummet, pushing gold and silver prices sharply higher as traders instantly assumed this softening data would constrain the Fed's tough stance.
I mean, just look at the sheer speed of this unraveling. On July 1st, Warsh delivers his hawkish Sintra speech. The very next day, July 2nd, a weak jobs report forces rate expectations straight down. And then, as if the Fed didn't have enough of a headache already, on July 8th, President Trump declares the Iran agreement over at a NATO summit. Within just 10 days, markets watched a hawkish chairman get undercut by a weak jobs report, only to then watch the very geopolitical ceasefire he had leaned on for optimism completely collapse.
And the market reaction? Instantaneous. As U.S. tankers were struck and fresh sanctions hit Iranian oil, Brent crude just jumped 6% right back into the high 70s. This surge in energy prices reignited inflation fears immediately. Because of this, the rate hike odds for September climbed right back above 60%, causing gold and silver to whipsaw violently back down from the highs they had touched just days earlier. Talk about a roller coaster.
Section 3. Silver's Dual Identity Exploit.
So you might be wondering, why exactly did silver react so much more violently to this 10-day thriller than gold did? Well, it all comes down to a massive structural tug-of-war. See, gold is primarily a monetary asset, but silver? Silver has a dual identity. It acts as a monetary asset to hedge against currency debasement, but it's simultaneously heavily reliant on industrial demand as a really crucial component for solar panels, electronics, and EVs. A weakening labor market threatens its industrial demand, pulling it down, while fresh inflation risks from the Middle East ignite its monetary identity, pulling it up.
And that intense push and pull? That's exactly why we arrive at this specific number, 69. Right now, it takes roughly 69 ounces of silver to buy just 1 single ounce of gold. Because of those contrasting forces acting on silver's dual identity, this ratio is sitting at a level that analysts consider pretty stretched relative to recent history.
Section 4. The hidden structural floor.
Okay, let's take a step back from all the noisy, surface-level events of the past week. Let's look at the quiet, massive structural forces acting like a giant iceberg right underneath these markets. Despite all the short-term Fed drama we just covered, a World Gold Council survey reveals an incredible 89% of central bankers expect global gold reserves to rise over the next year. They are simply not paying attention to short-term rate noise.
You see, central banks are operating on a completely different clock than the Federal Reserve. Just in May, official institutions added a net 41 metric tons. Poland alone accumulated 64 tons this year as they march toward a massive 700-ton target. And China's central bank? They've bought gold for 20 consecutive months. They are relentlessly hoarding physical metal to the point that gold has actually now overtaken U.S. Treasuries as the largest global reserve asset for the first time since 1996. That's a real game changer.
At the exact same time, the structural story for silver is getting incredibly tight. Silver is currently facing its 6th consecutive annual supply deficit. By 2025, we're looking at a 40.3 million ounce shortfall, and that's projected to widen to 46.3 million ounces in 2026. The market has already drawn down 762 million ounces from above-ground inventory since 2021 just to cover the existing gap. The cushion beneath this market is thinning dramatically.
Section 5. The ultimate policy tension.
So you take all of this short-term volatility, layer it over those massive structural realities we just talked about, and it brings us to the ultimate policy tension. Warsh is currently pulled between two mandates pointing in completely opposite directions. Are we going to see a Volcker-style commitment where he tolerates real economic pain and a softening labor market to protect his credibility? Or will it be conditional toughness, where the weakening jobs picture forces a fast pivot to easier policy regardless of what oil is doing? Historical data shows us that precious metals thrive precisely in this kind of environment, one of genuine unresolved policy tension where the central bank is forced to choose.
As we wrap up this explainer, I want to leave you with one final provocative thought to help evaluate your own portfolio. When the economic and political pressure truly intensifies, which of the Fed's promises gives way first? The commitment to price stability or the defense of political independence? How you answer that question is going to define how you navigate the incredible tension ahead. Thanks so much for joining me on this deep dive, and I highly encourage you to keep